Question 1 looks like a lot of past exam questions in that we've been told we're going to evaluate the performance of a trading firm. So that's a firm that sells inventory as opposed to a business that provides a service. So remember in year 12 we only do trading firms. And then, which is really common on the exam, they give us a whole bunch of indicators. So in this case we've got 5. We've got the working capital ratio, the quick asset ratio, accounts receivable turnover, inventory turnover, and accounts payable turnover, and we've got them for 2 years. We've got them for 2021 and 2022, and then we've got a whole bunch of questions about them. So before we answer those questions, we should probably just look at, well, what does each of these indicators tell us? So the working capital ratio is our current assets divided by our current liabilities, and that tells us for every dollar of current liabilities the business has, this is how many current assets there are to pay them. So if we were to look at the 2021 figure, this is going to measure liquidity. So we've got here in 2021, now we don't know specifically what the current assets and current liabilities are for this business, and that's why it's such a great question, because it requires you to know this so you can talk about this stuff without being given the actual info. But usually the common current assets for a business are its bank, its inventory, its accounts receivable, and any prepaid expenses, for example the rent. And its most common current liabilities will be accounts payable, loan to the bank, accrued wages, or sorry, any accrued expenses, in this case wages, and possibly the GST clearing account. And what we need to do is we need to be able to pay these ones here in the next 12 months, current liabilities, with the ones that will provide us with an economic benefit for the next 12 months. That's our current assets here. Now we don't know these in particular, but we do know this indicator tells us that for every dollar on this side here, there is in 2021 $1.91 to pay them, which is really good. So we've got almost double the amount of current assets to pay these current liabilities. And in 2022, for every dollar of current liabilities, it went up to $2.46. So it looks like we've got more than enough current assets to pay our current liabilities. So that looks pretty good, that trend. However, we've also been given the quick asset ratio, and that tells us we take the exact same formula as the working capital ratio, so it's current assets divided by current liabilities, but this time we take out inventory and prepayments. And that tells us for every dollar of current liabilities the business has, this is how many quick assets there are to pay them. So what are we talking about here? Well, it's going to measure liquidity again, and if we look at the current liabilities, assuming, we don't know any of these numbers, but just this is what this tells us, for every dollar here, if we take out inventory and prepaid expenses, in this case rent, how many quick assets, so in this case we're just left with bank and accounts receivable, how much of this is there to pay this? Now the reason why we do that is because inventory is not easy to sell. You got to buy it, you got to market it, and you got to sell it, and also collect the amount of cash owing from it if it's a credit sale. So what we do is we say, well, this is not really a quick asset. It takes time to convert into cash. And this one here, any prepaid expense in the future, that will never become cash, because every asset's an economic resource for the future. And in the future, so what's the economic benefit or resource of bank? Well, bank, you can spend cash. But when you prepay an expense, it's not like you're going to get money in the future. For example, if it's prepaid rent, you're just going to be able to occupy the property. So why are we taking these two assets out? Because they're not quick. Inventory takes time to sell. It's not easy. And prepayments will never ever become cash. So we're going to exclude those. And when we do that, we can see in 2021, we've got $1.82 of these quick assets here to cover current liabilities, and that's still really awesome. So anything above 1 means technically you can pay your current liabilities. However, in 2022, for every dollar of current liabilities, if we now exclude inventory and prepayments, we've got a bit of a shortfall. We've only got 68 cents of quick assets to pay them. We were also given the accounts receivable turnover. So there's the formula. What does it tell us? It tells us how many days on average it takes to collect amounts owing by accounts receivable. So this one measures efficiency and liquidity primarily. So in 2021, if we made a credit sale on day 0, it was taking us, it says here, 37 days to collect the cash from accounts receivable. And in 2022, that went up to 49 days. So that got slower. So that's taking us longer to get the money from our customers. We've also been given the inventory turnover, which was 64 days and 82 days. What does that mean? Well, we've got our formula here. It tells us on average how many days it takes to turn purchases of inventory into sales. In other words, how many days does it take to sell inventory? And this one measures primarily efficiency and liquidity. So in 2021, on day 0, if we bought inventory, it's taking us 64 days to sell. And in 2022, that's gone up to 82 days. So we are now slower at selling inventory. We were given the accounts payable turnover. That was our final indicator. What does that tell us? Well, there's our formula. It tells us on average how long it takes to pay amounts owing to accounts payable. And that measures primarily efficiency and liquidity. So in 2021, if we bought inventory on credit on day 0, it was taking us 49 days to pay back accounts payable. And in 2022, that got much faster. It went down to 27 days. So we are paying back our accounts payable faster. That's all the indicators we were given. However, one good thing to have up your sleeve that is not officially in the study design is to talk about the cash cycle. What is the cash cycle? It's simply when we add together these two indicators here. So if we took the inventory turnover and added the accounts receivable turnover. So in 2021, for example, 37 plus 64 is 101 days. 49 plus 82 is 131 days in 2022. What does that tell us? It tells us about efficiency and liquidity. So if we look at 2021, the cash cycle, we bought inventory here on day 0. It was to sell inventory turnover 64 days. It was taking us 64 days to sell inventory and then another 37 days to get the money from accounts receivable. So if you add that to 37 days from there, that ends up being 101 days before we get the money. And in 2022, that blew out a lot. It took 82 days to sell the inventory, and then we weren't getting the actual cash until 131 days. That's like over 3 months. That's a quarter of the year. And what we always want to do with our cash cycle, so we've got something to talk about, is compare it to our accounts payable turnover. So look at this. In 2021, when we bought inventory on credit, we were paying for it in 49 days. We hadn't even sold it by then. Had sold it. We're taking 64 days to sell it. So how were we paying these people back, these accounts payable? We must have been borrowing money or getting contributions from the owners or selling non-current assets. So that's not good. There's like over 50 days between paying for inventory and getting the money from it. And in 2022, it got even worse. There is over 100 days difference between when you were paying for inventory to your accounts payable and when you were getting the money. So we can talk about that later. So what are the questions we've been asked? Define what is meant by the term liquidity. We don't have a lot of definitions on past exams in accounting, but this is a pretty common one. We say liquidity is the ability of a business to meet its short-term debts as they fall due. So just remember when you're doing this, don't stop after the word debts. Don't say liquidity is the ability of a business to meet its short-term debts. We've got to say as they fall due, because you can meet your short-term debts. You might have a phone bill this month. You could pay that next year. That's still meeting a short-term debt. So what we want to say is as they fall due. Question B, explain the trend in the firm's working capital ratio. So it went from 1.91 to 2.46. So that's our little formula there. Where could we explain that? So pretend we're explaining it to someone who knows nothing about accounting. The working capital ratio increased from 1.91 to 2.46. Yeah, probably don't need that to be honest. But to explain it, this means that on average, for every dollar of current liabilities the firm has, there are now, in 2022, I wrote $2.50, I've rounded up. We should say $2.46 of current assets to pay them. So yeah, rounded up, but that doesn't matter too much. The point is, there's more current assets to pay the current liabilities. But now we're kind of out of things to talk about. Explain it. Now we know nothing about this business, but we do know what current assets are. So you could say, well, why did this go up so much in 2022? I reckon it might be because these two things here, accounts receivable and inventory, they're both current assets as well. And if you look at 2022, accounts receivable went up in terms of the number of days. So that probably means we've got more accounts receivable and we're taking longer to sell inventory. So that probably means we've got more of it. So I said, and again, we don't know this, so we're just by inferring, that's showing our knowledge, and that's a really good answer. We're saying this may have been because the current assets increased, which is evidenced by the increase in the inventory turnover and the accounts receivable turnover, which and that probably suggests both of these current assets increased in 2022. So how could the working capital ratio go up? If the number on top could go up and get bigger, that's what I've said here. You could have also said maybe the number on the bottom got smaller. That's another possibility you could have used too. But I said this got so much better because this number here went up. Why did it go up? Because I reckon I've got a lot of inventory and a lot of accounts receivable, and the data backs me up. Question C. Explain how the quick asset ratio can decrease. So it went down from 1.82 to 0.68 despite an improvement in the working capital ratio. So we've got to know how these are calculated to answer this. So they are basically identical. We've got current assets on the top, current liabilities on the bottom. It's just on this side we take out the inventory and the prepayments. So I can explain that one pretty easily. For the quick asset ratio to decrease despite working capital ratio going up, this must mean the firm's current assets consisted of a lot of inventory and prepaid expenses, and these are excluded from the quick asset ratio as they are difficult or impossible to turn into cash quickly. But I've only got, this is 2 marks, I've only said one thing. Any data to back me up? There is. So let's take inventory. It's pretty clear that I reckon we have more inventory now than we did a year ago, but that's because we're taking longer to sell it. So for my second part, I'm going to explain this by saying the trend in inventory turnover supports this, as we are taking longer to sell stock, which means it's being held longer, and therefore there would be more inventory on hand at the business. Finish now with a couple of big questions. So this one's 4 marks. Explain the trend in the firm's accounts receivable turnover, and then discuss its impact on the firm's profitability. Now this is not a profitability indicator. We said it's efficiency and liquidity. However, that does impact our profitability. So let's do the explaining first of all. 37 to 49 days. That means that in 2012, should say 2022, on average, the firm is taking 49 days to collect amounts owing from accounts receivable. Okay, so you've explained what it means. How could that happen? There's many reasons. I just made one up because you're allowed to. We don't know anything about this business, but we should know why accounts receivable turnover might get slower. So I've said maybe it's because we don't offer discounts for early payments, or maybe our discounts are really low, and therefore accounts receivable have little incentive to pay faster. That's one possibility. There's many others. That's just one I used. If you used any rational possibility there, that's going to get a mark. Now we've got to discuss the impact on profitability. So first of all, don't think profit's a different thing. Profitability is going to be any of these indicators: our gross profit margin, our net profit margin, our return on assets, and our return on owner's investment, ROI. So we can talk about any of these. So it doesn't matter which ones, but, and it says discuss here. So that must mean we've got to say how one of these is going to be affected positively and then negatively. So what does this tell us? It tells us accounts receivable are taking longer to pay us. So I guess one positive of that could be if accounts receivable are paying slower, the business will be giving fewer discount expenses, which should mean its net profit margin goes up. So if we give people a discount, that increases other expenses, that makes net profit go down. So I'm saying that would worsen this profitability indicator here. What are the negatives for profitability here? So we can't say, oh, the negative is we're taking longer to get money, because that's liquidity or efficiency. We want to talk about profitability. How could any of these be worse off because of this? So I said a negative of this trend is that the business, to get this number down, might need to hire debt collectors. Now when you hire a debt collector to chase up outstanding debts, that's going to increase your other expenses, and that will lower this net profit margin. So remember, when you get asked about profitability, you're talking about these indicators. You're not talking about gross profit and net profit, for example. You're talking about gross profit margin and net profit margin. Now, there were many things you could have spoken about there. Another possible positive you could have said was accounts receivable may be slower to pay because maybe we increased selling prices, and therefore the amount that each account receivable owed went up. So that would logically take them longer to pay. And then you go, well, that would increase my gross profit margin if I increase selling prices. What are some other negatives? Well, you could have said the longer accounts receivable take to pay, the more chance there's a bad debt. Bad debts is an expense, and that would lower net profit margin. Or you could have said the longer our customers take to pay means maybe we need to take out a loan. Loans incur interest. Interest is another expense, and that lowers net profit. Our final question was discuss, based on all the above indicators, whether the liquidity now, that's our ability to pay our short-term debts as they fall due, has improved in 2022 from the previous year. So with the discussion, remember, we're going to have both sides of the argument. So I have to make an argument here that it's improved, and then I'm going to make another argument that it's deteriorated. You don't have to do it in that order. It can be in any order you like. That's just how I do it. I start with the goods. So the good, I guess I could say, was the working capital ratio went up. So by definition, that means you've got more current assets to pay current liabilities. But now we just got to say, what's that got to do with liquidity? So I think that means I'll be able to pay those current liabilities as they fall due. I'll be better able to do that. So now I've said that what that's got to do with liquidity. And then that's probably the only really good one. I just did find another good one. Now, you don't need to give an equal number or anything. Obviously, there's 5, so you can't do that. But we need to just have at least one good and one bad. I found another good. I said if the accounts payable turnover has gone down from 49 days to 27 days, that means you are paying accounts payable faster. That is the very definition of liquidity. Your liquidity has improved because you are paying those debts back quicker as they fall due. So we did have proof that liquidity got better. But on the other hand, there's lots of ways that liquidity deteriorated. So these are just some of the things that I found. There's many things you could talk about. I said the quick asset ratio going down means we've got fewer quick assets which can be converted to cash easily, e.g. bank accounts receivable, and therefore that's going to make it tough for me to pay current liabilities as they fall due. So I'm relating that back to this term liquidity here. What else was bad? Remember, not in the study design, but the cash cycle just gets you so many marks if you know about it. The cash cycle went from 101 to 131 days, and that means it's taking me over 3 months now to sell inventory and collect cash. So if I'm taking 131 days to get cash from selling inventory, how am I paying all of my current liabilities that are due in less than that time? Some bills are due every month, the rent, insurance, wages. How am I paying them? So my liquidity is clearly bad because I'm taking 131 days to get the money. And lastly, I went with, this is made worse by the trend in the accounts payable turnover, because when you think about it, I'm paying, so we said paying people back in 27 days is really good up here, but it's also really bad if you look at it in the context of the cash cycle. It took 27 days to pay people back, but when I'm not selling the inventory for 131 days, so how are you paying it? You must be taking out loans. Now, I don't know that, but that just shows really good knowledge. So I said, you're taking out loans to survive, and that would decrease your future liquidity. So just make sure with all of your points, when you're talking about good and bad, you're relating it, not just saying like this indicator is good or bad, but what's that got to do with liquidity in this case? So remember to answer the question, the term used in the question.